Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting. And our topic today is statement of cash flows indirect method. So statement of cash flow is one of our financial statements. We also have videos about the other financial statements. They are in our video description. Okay. So what is the statement of cash flows? Required for each period when balance sheet and income statement are presented, provides information about the cash receipts and cash disbursement of an enterprise. Cash refers to cash flows, cash equivalents, and restricted cash, helpful in assignment, future profitability, liquidity, and long-term service. Basically, is the reconciliation between accrual basis accounting, that is balance sheet and income statement, and cash basis accounting. Basically, is okay. We have our income statement, our net income or net profit, depending where, where you are. What if we were working with cash basis instead of accrual basis? And we have these three categories. And these reconciliation between profits, they are the operating activities. How much would be my net profit or loss or net earnings or net losses if we were working about with cash basis accounting instead of accrual basis accounting? And we have investing activities usually related to long-term assets and financing activities related to long-term liabilities and other stockholders' equity that is not the income, the net income. Okay, so operating activities, inflows and outflows of cash that result from activities reported in the income statement. And the cash inflows, sale of goods or service, interest and dividends from investments, outflows, inventory, salary, wages, and other operating expenses, interest and income taxes. Here, a very small difference between US GAAP here in the USA or IFRS. Oh, very difficult word about international accounting. Usually, international accounting, they don't consider interest as operating activities. Interest received, they consider it investing activities, and interest paid, it is financing activities. So, a very small difference between US accounting and international accounting here. So, if you are in the US, consider this one. If you are not in the US, interest they are investing and financing activities. Okay. And we have two methods. Direct methods, we also have a video about direct method and the indirect method today. Net flow is derived indirectly by starting with reported net income and working backwards to convert that amount to a cash basis. So that is why it's indirect. We start with our net income and then we create a lot of adjustments and we will be talking about it later to find our operating cash flow. Investing, usually assets. The outflow, purchase of these assets. Long-lived assets, investment, or loans to other entities. That is your assets. Cash flow, the payments, or sorry, cash inflows, the receivements, the sales of these assets. Okay? And finally, financing owners and creditors. So the inflows from owners when shares are sold, from creditors when we borrow money. Outflows to owners when we pay dividends, and here it doesn't matter if we are talking about US accounting or international accounting. Owner for the reacquisition of shares previously sold, or to creditors. Okay, I am not in your screen anymore. As repayment of the principal amounts of debits. Okay, and if we are talking about international accounting, we combine interests. Okay, but let's check how it works. We are talking with two statements of cash flows, Coca-Cola Company, US company, and FCA Group or Fiat Chrysler Automobiles, and Italian-based group. So US GAAP and international accounting. This info, they are not classified or restricted. If you go on these two web pages here, and they are based on the website of the company, so Coca-Cola company here, FCA group here, you can download it, no problem. Or I copy and paste these links in our video description, so you can download it there as well. Let's go here. Coca-Cola company, the statement of cash flows, they are on page 71. And the indirect method, the most important one is the operating activities. Let's check how it works. We start with the net income, almost $9 billion. It is in million dollars here. And then we adjust it with the non-cash revenues, expenses, gain or losses. Most important one, depreciation. We never pay depreciation. This is my module in my financial accounting classes. We never pay depreciation. Our journal entry is debit depreciation expenses, credit accumulated depreciation. So we have expenses and no cash. And we add it to our income. Why? Because these expenses, they are decreasing my operating income in my income statement. So to adjust it, we need to do the reverse. So we need to add it. Stock-based compensation expenses, again, non-cash expense, so we sum it. Deferred income taxes. Deferred here probably is a revenue in their income statement. So that's why. And deferred income taxes, it is a long-term income taxes. So we will not be paying that. Equity income or loss, it is based on the other companies' uh, incomes and we adjust our investment. So it is a here revenue in our income statement, but a non-cash revenue as well. For the currency adjustment, it is a other comprehensive income here, but also non-cash. And other gain or losses, that is non-cash as well. And then here, net change in operating assets and liabilities. They don't disclose it. We can do it on US accounting, not recommended. And we will check FCA, they don't do that. So they have a much better income statement. And let's go to FCA, and then we finish the operating activity. So the FCA is on page 171. So here, net profit from continuing operation, the same, and our amortization and so on. So we have it, it here. And then our changes. These changes, they are changes in our working capital, our current assets or current liabilities. How does it work? For instance, changes in inventory. If we go to our inventory, let's find it here. Inventory, where are you? Oh, inventory. Inventory, we are decreasing inventory here. Okay, a little bit more than 1,000 or 1 billion if we are talking about millions here. So if we are decreasing inventory, that means we sell it. So we sell more than we purchase. So when we decrease inventory, we are adding our cash. Trade receivables, we are also adding it here. Where are you? To do trade receivable, also it is decreasing our accounts receivable here. So we are receiving it. If we are receiving it, it is adding our cash. So adding our cash. And also about payables. Trade payables also increasing our cash. Why? Let's go here. Trade payables here. It is increasing our accounts payable or trade payable as they call it. So if it is increasing, I purchase it, so it is in my income statement. However, it is not paid yet. It will be paid only the following period, the following year. So we also add it in our cash. Changing other liabilities, payables, and receivables. Uh, Other here, and also they combine some other accounts here, but it is decreasing. If it is decreasing, it means that we are paying it. So if we are paying it, we should decrease our cash. So how these changes works? Assets, we do the opposite. If my asset increases, my cash decreases. Remember, guys, debits and credits. Cash it increases, debit, so we need to credit our cash, so decreases. And the opposite, if our assets decrease, our cash increases. Liabilities, we do the same. If our liabilities increase, our cash increase. Why? Liabilities increase it, we need to credit it. So we debit our cash and then we increase our cash. When liabilities decrease, our cash decreases as well because we need to debit liabilities to decrease it. So we credit our cash and also our crediting cash, we decrease our cash. And investing activities, that is the same here. So let's go back to Coca-Cola. Purchasing, when we purchase it, we decrease our cash. When we dispose or sell it, we increases our cash. Financing, issuance of debit, new debits, we are increasing our cash. Payments, we are decreasing, the same as stocks. And then the total of operating activities, net cash provided, that is our positive cash here. We are increasing our cash. IFRS, they call it from cash from financing when we have the positive numbers. When the total is negative, net cash used in investing activities. The same as international accounting, use it. And when we combine operating activities, investing activities, and financing activities, we have the net uh, we have uh, the net increase here. In here, we have the net decrease. And we start with the beginning balance of cash. When we combine the increase or decrease with the beginning balance, we have the ending balance. And we double check if our numbers are right. International accounting, exactly the same. Total cash, total change plus beginning period is equal to cash at the ending period. Okay, guys, so thank you so much. Subscribe our channel, please. You will be the first one to know when a new video is coming or arrives. Usually 3 videos per week. Also, like our Facebook page, Accounting Hub by Dr. Scarping. If you have questions or comments, email me at dayscarping@gmail.com or leave your comments here. Guys, have a very nice day and God bless you.